Yeah.
Yeah. Well, all right, folks. I think without further ado, we got a lot to cover and a good bit. My colleagues, Dana Bickford and Dick Hindy, have volunteered and put together a bit of the closest thing we'll ever do here to a formal program, if you want to call it that. But as I shared in the email, the topic of today is working capital and cash, and thinking about ways to, number one, define it, analyze it, and target it. But number two, protect yourself through the closing journey to be sure that everything that maybe you and the seller negotiated was actually going to happen and does in fact happen. So I'm not going to lie, I don't want to get into a lot of the weeds, but one of the precipitating factors of why we think this is an important discussion, we have had several of our AEs that went to closing and quickly discovered within the first 30 days that they felt cash squeezed on their business. And the remedy to get over that hump is not always pretty. It can be costly. To my knowledge, we haven't had anybody pay exorbitant or extraordinary fees quite yet to fix the gap. But nonetheless, we want to talk about ways to properly assess and estimate your cash need for your business, get the working capital nailed down in your closing docs, and move forward in a positive and healthy way so that cash isn't your first worry in the business. So with that said, Dana, I'm going to turn it over to you and let you take off with your material there.
Okay. Okay. Thanks, Doug. Everybody hear me okay?
Yeah. We're good.
Okay, good. I'm going to make the grandiose assumption that everybody's familiar with the term working capital. And I know everybody's familiar with the term cash, and you know what cash is. Working capital is discussed a lot when it comes to acquisitions, but it's an abstract concept. It isn't really a thing. It's a concept. It's important, but you can't use it to pay your bills or your payroll or your debts. Accounting rules define it as current assets like less current liabilities, and that's fine. It's an important concept intended to show what the current liquidity of the company is, but it can be manipulated. Purchase agreements can define it any way they want in an acquisition. But regardless, for the first few months of your ownership of your new company, cash is what really pays. That's what's going to pay your payroll. It's going to pay your bills. It's going to pay your debts. Look at it this way: cash is king, and it's your company's lifeblood. And we don't want to confuse the two. Both are important, but for the first few months of your ownership of this company, cash is where you need to be focused. Okay. We see situations, and I'm going to cover 2 or 3 topics here. Hopefully, there'll be a pattern to it that will make sense to you. But we see situations that can cause post-close challenges with respect to liquidity. And here are some things to think about. The first one is every one of these things that I've seen, both here at Acquira and in a couple of previous lives, we see a drop in post-close revenue with smaller companies. It just happens. It can happen for a variety of reasons. One might be seasonality. You just bought an HVAC company during the peak of the season, and the fall comes along and work slows down. That's seasonality. Another might be the timing of jobs. Generally these sellers really step on the gas. They get a lot of jobs going before closing as they're marketing their company, and as they get a little closer to the sale, they may take their foot off the gas a little bit. They kind of see the light at the end of the tunnel, or it just may be a natural change in the market a little bit. So that can change or can cause a reduction in revenue. One of the things that we're seeing after closing is a lot of the times these smaller companies, the owner, the seller, is the person that's doing the bidding. They're the chief estimator. And in most cases, as the Acquira model it very accurately says, they're the chief cook and bottle washer. They do everything, and that's part of the reason they're selling. They can't manage all of that. But a lot of times they are the most valuable estimator in the company, and maybe the only one. So they are going to go away in 1 month, 2 months, 3 months, for whatever you negotiate for. So that is important to understand, that's going to happen, and it could affect your revenue. A key employee that might be an estimator or a bidder, or have a key role might also walk out the door for whatever reason. We see that less frequently, but it does happen. So my advice to everyone is to ask yourself, what's the key talent here? What's causing the revenue to come in? And not just ask yourself the question, but do a little research before you close so you know where you're going to go if the inevitable happens. What do I do about this? If we just lost our best estimator, how do I replace them? And who do I call? Ask yourself that. If you have that in the back of your mind before you close, you're further ahead than a lot of folks who will get into these transactions and then realize 2, 3, 4 weeks later that things are dropping off, and they're scrambling at that point to find a replacement. A couple of key things to think about as you're going to close on one. Let's say your owner is the key estimator and the most talented technical person on board, and they are going to disappear. So you're going to have to replace them. Are you in a very heavily unionized market? If so, it might be kind of difficult to get a replacement that is as talented as your owner, as your seller. That can be a challenge. So you really need to think that through. Are there licensing requirements that somebody coming in as an estimator bidder, or whether it's a chief electrician or plumber or whatever it is, are there licensing requirements? And if you're in a heavily unionized environment, it may be challenging to get them to come to your company, because typically the unions are paying higher wages than private companies are that are non-unionized. Those are key considerations. And the final consideration that I'd throw in there is that hiring in the trades is tough today. It's tough everywhere, but it's tough in the trades. So just make sure you've gone through the thought process. Where do I start? How do I do this? What are the sources I'm going to approach? Let me go back to working capital and cash a little bit. One of the negotiating approaches we've seen results in a split of revenue and expenses post-close between the buyer and the seller. And those are typically based on the ongoing jobs as of the closing date. So to the greatest extent possible, you need to identify what's going to be invoiced on or before closing and who gets the cash that comes in, because it may be invoiced, a receivable on the books at closing, and the cash comes in 15 days later, but if it's going to the seller, it's not going to help you. So take a look at that and make sure you understand that. And also, you need to understand who are the expenses going to. And it's good to map that out. And let me give you an example rather than talk abstractly about it. Let me give you an example. We had a company, the seller's firm was using a cash accounting method. They were pretty sloppy about it. Their CPA was pretty sloppy about it. We knew they were kind of sloppy about it. I think the most recent financials they had were 3 months prior or something like that, prior to closing. So, and there were multiple contracts invoiced right before the closing. And the way the purchase agreement read, the invoicing on contracts for work done prior to closing went to the seller. Unfortunately, all the payroll and all the expenses of the company, rent, truck and car payments, all that kind of thing, went to the buyer, which net resulted in the buyer incurring about 6 weeks of expenses funded without the benefit of any of the receivable collections, or very little. So as he plodded through those 6 weeks, those weeks seemed interminable, and it points to the need for really good working capital planning, or debt planning for a revolving line of credit. And I would just we're going to get to how you do that in just a minute. But the one thing you can count on is Murphy's Law, and as you plan for Murphy's Law to take effect, you want to build into your deal structure a pretty good sized margin for error. That's my advice. Another approach that we've seen just recently, which I kind of like, and I think it's pretty simple, is this. The buyer and seller agreed to define working capital as accounts receivable minus accounts payable. And they set a threshold level, which was pretty interesting. There was going to be accounts receivable minus accounts payable equals, and I'll just pick a number out of the air, equals $400,000 at closing. That's going to be left in the company. And then the buyer also would agree to leave $150,000 in cash in the account. So total, in that case, you're talking $550,000 in liquid assets that would play out over the next few weeks. What they then did was they agreed that if working capital was less than the threshold, then cash was paid to the buyer by the seller in the amount of the deficiency at closing or shortly after closing. And if the working capital as defined was greater than the threshold, then 50% of the receivable collections went to the seller until the excess was paid. So it was very clear, and they could identify it quickly, and they didn't have to wait until a couple weeks after closing to figure out what they actually had and what they had agreed to and how much liquidity the buyer had. So it's a little bit of a novel approach. It's kind of interesting. And what I like about it is it's fairly clear and you can define it pretty quickly. Buying a company is a risk management exercise, and sensitivity analysis with a model can help you plan for and help you manage that risk right up front. So what happens if revenues, margins, receivable collection patterns change? What if past due receivables become uncollectible? They're on the books that you bought, but they're uncollectible. What happens if payment terms change? They get sped up because your biggest vendor doesn't know you. They knew your predecessor, the seller, but they don't know you. So instead of giving you 45-day terms, they tell you you need to pay in 25 or 30 days, that sort of thing. That can happen. How do you deal with that? How do you plan for it? You model it. So a little bit of food for thought, and then I'm going to introduce Dick. A poor definition of, in the purchase agreement, of working capital and not really understanding how the cash flows in and out can really cause a lot of trouble for you. So you want to make sure that you and your lawyer are very much in sync on that definition, and that you pay attention, you know how cash is going to come in and how it's going to go out, and know how that definition works, how everything within the definition works. If you can do that, you're way ahead of the game. You're not guessing 3 weeks after the closing. One of the things you need to do in one of the companies, they included working capital. They included some past due receivables, and these receivables weren't just past due. They were huge, and they were 2 years old. And if the seller can't collect those things, chances are you're not going to collect them. So the way I would think about that, and there's a lot of different ways, and I haven't thought of all of them by any means. But since you're probably not going to be able to collect that, you might want to offer to collect it for the seller and get it out of the what you're buying. Collect it for the seller for a fee. You also um, may want to reserve the right to offset that against the seller note that you structure, and have a certain time frame that you have to make that decision. Or if I don't collect it in 90 days, boom, it's yours. That kind of an approach. And your counsel can advise you. Any of the folks on the call from Acquira can probably advise you or will have an opinion that could be helpful to you. Um, it's important. It's very important to be clear on how work in progress on existing contracts is addressed in the working capital definition in the purchase agreement. And does that purchase agreement give an opportunity to the seller to surprise you? In other words, you've been looking for the last 2 months prior to the closing. You've been looking at all these work in process numbers that they're reporting to you. And all of a sudden at closing, you realize that they've billed all of them. And that money may be going to the seller. That's a surprise. That's a surprise that affects your liquidity. So just be very tuned in as you're negotiating things with the seller, with the bank. Be very tuned in to make sure you understand how things can sort of how somebody can throw you a curveball and plan for it. So you've got some flexibility on the financial end. I want to introduce Dick Hendy. Dick and I work on a number of different clients together and frankly, worked together in a previous life. Dick's a master at helping entrepreneurs understand something that I think is critically important. I've used it with a previous employer, what we call a rolling 13-week cash projection. It's an awesome tool. And if you haven't used one or you haven't seen one, it's something that we bring to our ACE clients. It is a really, really important tool that gives you advanced warning if you're facing a liquidity squeeze. And that's what you want. The more time you have to make adjustments, the better off you're going to be. And with that, I want to introduce Dick. And Dick, if you would just go ahead and take it away and finish with that thought and any others you have.
Okay. Well, thanks, Dana. I think I got the ability to put something up on the screen here. Nope.
Yeah, you should have it, Dick. It's the little rectangle with the upward pointing arrow.
Yeah, I clicked on that and it's
Let me check something.
Oh, okay. Wait a minute. I clicked on that. There it is. See if that works now.
There we go. Yep, it's up.
There you go.
Okay. Yeah, this is something that that I created for years ago when I had customers that were complaining about cash flow and worrying about it more than complaining about it, I guess. And I continued to use it over the years, and we've introduced it to several of the Acquira folks. And the initial reaction is it's very cumbersome and taunting, and I can't do that. But once they see this thing in action, it kind of opens up their eyes and says, oh yeah, I see the benefit of it now. So we just got a title up here, NewCo Heating and Air Conditioning Rolling Cash Flow Projections. And I started with the September 1st date. And, you know, when you first take over one of these companies, you're drinking out of a fire hose. You're being introduced to the clients. You're trying to get the employees to, buy your thinking. You're trying to learn all of the things that the company's going on. And this is just one more task, but I think it's very important, because if you wake up one day and you're out of cash, then you've got some huge problems. So I would recommend that you work with, if I'm assigned to your account when you buy it over, one of the first things we work on is this rolling cash flow. But and we'll introduce it to the in-house accounting folks, and once they start playing with this, they get used to it, and it's almost second nature. But the basis of this, and going back to Dana's point, is that you can't pay bills because you've got a big list of accounts receivable outstanding. You've got to get the cash in. So the starting point of this is cash, and then just look on your QuickBooks and get a feel for what your outstanding checks are. And I can tell you, before we get to the bottom line on this thing, you're never going to be able to look at this and balance it to anything. These are estimates in a lot of cases. So it's just a really good model to see at the end of the week, if you will, you're either got cash or you don't have cash. So you take the cash on hand, you list the outstanding checks, and then you come over here to the accounts receivable. So you look at the aging report of the accounts receivable, and you put in, Fred's sandwich shop, and you did a, $15,000 job for him, and he typically pays within 30 days. So just because you did that job, you're not going to collect it here. You got to put that $15,000 out when he pays you at the end of that 30-day period. So you can see all the time when we get down here in expenses, you still have to pay your payroll, pay your rent, pay your utilities. But that big job that you just did, you may not get the money till over here at the end of the month. So what one Acquira customer did, he looked at his total aging schedule. He looked at the historical turn of that total aging schedule. So let's say it's 30 days or 34 days or whatever it is. So he just put one big number in here and just calculated out that percentage of his outstandings and just kept moving that thing over as it happened. That's an easy way to do it. But if you've got, a big receivable, you may want to actually put that down for what day or what week it's going to come in so that you can account for it. Now, so you've got that piece done, and let's see if this thing is going to advance for me. It's not advancing, okay? So you're going to come up with your total collections, and now you're looking at your disbursements, and you've got expenses, and I just broke out here the ones that you basically probably are going to be paying every month to keep your lights on. So you got payroll, and a lot of these companies pay weekly. And again, you can look at what your historical has been on an annual basis, divide by 52, easily comes up with your weekly payroll. The owner's salary may be in there. So if he's leaving and you're not paying him, you want to adjust that down, or you're going to be overestimating. And then you put in, if your office workers are broken out separate, put their paychecks in there. Now you take out from your employees 6.2% for Social Security, 1.45% for government Medicare, Medicaid. You as a company also have to pay that same percentage. So once you get these two numbers in, you just multiply whatever those two numbers are by 7.65, and that's the amount of taxes that the company is going to be responsible for that they have to pay. A lot of small companies have to pay that weekly. Some bigger companies have to pay it monthly, but factor that in, what day or time that's got to be paid. And then insurance payments. You've got workers' comp. You got all your other insurance, auto insurance, liability insurance. Generally, those are either weekly or they're paid in one big premium. So again, you can look at your historic model and say, okay, yeah, we pay the workers' comp every week, and just plug in whatever that number is and go across on a weekly. Same way with the phone and utilities. You just look at your historical 300 a month, or say 400 a month, and just put in either a time frame when you pay that, the 15th of the month. So you wouldn't have $100 every week. You would put it in typically when you pay that payment, 15th to the 30th. So you're going to have some weeks here where on some of these other expenses where there's no figure at all. Legal and accounting, same thing. If you've got an outside accountant that you pay for doing it, they bill you and you pay them at the end of the month. So you're going to have $0 the first 3 months and then $500 that last week of the month. And then same way with fuel and tolls. Most of them have credit cards, so you've got a credit card that comes up on the 15th. So plug in historically what that's averaged for the credit card receipts. So now you're going to look at, okay, I've got my expenses in here that keep the doors open and lights on and my people paid. What are my other expenses? You've got, somebody you're paying to probably run your computer system. You've got somebody that, comes in and cleans the place. You got other things that just normally are business expenses. So look at what that figure is per month. Take out these that you've already calculated, and whatever that difference is,
low battery,
is going to be either a weekly or a end of the month fee. I always tell people to plug that in weekly because those bills are going to come in various dates, and instead of trying to figure out how much of this I'm paying this week and how much I'm paying next week, just divide it by 4 and put it all in across the board weekly. This miscellaneous one is for any big items, like if you've got a down payment that you're going to make on a truck, or buy a new piece of equipment or something, you've got a cash outlay, put it in there that week that you're going to have that. But again, 9 times out of 10, this is probably going to be 0. Doug, how do I advance this thing? It doesn't look like it's advancing for me to get to the bottom.
You're not able to scroll your spreadsheet there?
Yeah, I've got it here, and it's not going down.
Go over to the window where the live spreadsheet is. You can't advance it from the Google Meet screen.
Oh, okay. So I'll have to go out and then come back in.
Well, yeah, if you don't have it on a dual screen of some sort.
Yeah, okay. I think I do. Let me go back over here.
There you go.
Is it advanced?
Yes, that's got it.
Okay, cool. Well, cool. I learned something. You can send me a bill, Doug. So now you're going to come up with a subtotal. And here's the other places where you're going to be guesstimating. And vendors are the people that you pay for your goods. If you've got a supplier that an electrical business that you buy all of your electrical wire from, if you've got a business where you buy Freon for air conditioners or whatever it is, whoever your vendors are. So you just plug some of their names in here, and then you figure out what typically week you're going to pay them. And it might be, as Dana said, you may have historically, the company paid those vendors every 40 days, but now they want, every 20 days until they get to know you better and how you pay. So those are going to be payments that you're going to plug in. Suppliers are people that supply you stuff that's not up in, you've already accounted for in the expense side. It may be anything that fits in a supplier. So you can probably have very few items in here, and there may be one. So anyway, take a look at the historical financials and see what kind of payments are going out.
Low battery.
Then you come down here. Okay, you got to start making your SBA loan payments and your line of credit payments, a seller note payment. Some of those will be interest only for a while, and whenever you schedule to pay them, you plug it in that particular week. So now you add up all of your disbursements. You go back up to the top and you look at your revenue you've got coming in plus cash on hand, and you're going to have an ending cash figure. And that number is either going to be black or red. And if it's red, then you've got to figure out, okay, who am I not going to pay this week so that I don't dip into a negative number? If that is nobody, then you may have to consider, what do I have under my line of credit so I can borrow, so I can get that negative figure positive and carry it up at the top to start the next week. It's also very good if you to look at for if you've got a big payment that you know is going to come due, to factor that in whatever week it's going to be due, so that you can take a look at it and see what you're going to have a negative or a positive. And you may have to delay that payment or go to the person and say, hey, I can't pay this week, I can pay you next week. The further out you go on this thing with the non-regularly scheduled monthly or weekly payments, the harder it's going to be to get that bottom line zero unless you got a big cash surplus. Because you're going to be estimating out here 13 weeks. And if most of your jobs are short-term jobs and they pay you within that 30-day period, you're really going to be forecasting then how much work you're going to do in those outer months, or outer weeks rather, and it gets a little bit grayer. So now there's two items that are usually on a financial statement that are what they call non-cash items, and that's depreciation and amortization. So to go back to Dana's point, don't add those in, because you're never going to write a check to anybody for depreciation. You're never going to write a check to anybody for amortization. They're non-cash items. So if you factor those in, you're going to be shooting yourself in the foot because you don't have to make that payment. So I highlighted that or put it down here in red just so that you don't make that mistake and do that. So that's kind of the 10,000 foot overview on this 13-week rolling cash flow. I know it's a lot to absorb in a relatively short period of time, and not having the actual numbers in here makes it harder to visualize what this is going to look like. But I can't stress to you the importance of doing this, because it's really going to be an eye-opener for you the first time you do it. A couple of other points that I want to make before I throw it totally open for questions, and that is a couple of these accounts we've worked with, the individual, after they got in there a couple of weeks, noticed that the fleet of vehicles that the company had were older vehicles with a lot of miles on them, and they needed to replace those vehicles. And we tried to get a company that specializes in that to do that for them. But because they were a brand new company in the eyes of the lender, because they're a new owner, we couldn't get that done. So if you look at the fleet of a company that you're going to buy, and get a rundown of how old it is, how many miles they have on it, and build into your financing that you need. I need to replace 5 trucks at $50,000 a truck. That's $250,000. And have a term loan set aside for those types of purchases, so that you don't get caught by needing vehicles and not being able to get the financing on them. The other thing I wanted to throw in is the SBA will give you what's known as an interest-only period of time. And they typically do that 2 times over the life of the loan. So a lot of SBA lenders don't like to do the initial year or 6-month period of interest only, because now you've used up, one of the 2-week periods or 2-year periods. But if you have to make an SBA loan payment of $70,000 30 days after you close, And some of the things that Dana mentioned, you don't get the receivables, you don't get some of the things that are coming in there. You're not going to have the money to do that. So negotiate, make sure you negotiate with the lender up front at least a 6-month interest-only period on your SBA loan, and then start making the principal reduction after that 6 months. I like to do with the people I work with a year, just to be on the safe side. And most SBA lenders will do that. Some of them are sticklers, like say they want to leave that option open in case the company runs into trouble 4 or 5 years down the road. But I would negotiate it during your hardest period of time, and that's when you're trying to get your arms around this thing that you just bought. So I'll throw it open for questions. And Dana, did I forget anything that we talked about?
No, I think you covered everything. The only I don't know if either one of us covered the I think it's implied in what we both were talking about, and that is the requirement to negotiate with the lender for a revolving line of credit more than what you think you need.
Yeah. And some lenders will tell you there's a $5 million maximum on SBA loan, and they'll tell you that there's no room for a line of credit. Well, there is, because they can make the loan without the SBA guarantee, and it would be in their best interest, if they're going to loan you $5 million, that they make sure you've got enough working capital or cash to carry so you can start making those payments. So it's in their best interest to piece that deal together. It just won't have an SBA guarantee, but they've already got a lien on all the assets, so they're not behind the 8 ball by any stretch of the imagination.
And the other thing I'll add to all of that, in terms of finding liquidity quick and being available, any of you that are contemplating the stock purchase as opposed to asset purchase, you get the benefit of the credit history of the company pulling over with you. And we have had AEs in the past who did that and immediately went to, for instance, American Express, and got a $250,000 line of credit overnight to support, just as a reserve or a backstop in case there were some of these Murphy Law unplanned surprises. They had the liquidity available, and yes, you're paying an interest rate for it, but you got the cash, you got access to cash that can tide you over. So those are considerations very much on the checklist of pros and cons for asset purchase versus stock purchase on your business structure. Rich, any other thoughts that you may fill in that we haven't covered yet here?
Sorry. Well, one thing, I think Dick and Dana made some great points. One thing, kind of sitting in the CFO controller seat in the past, is the forecast. That's a great forecasting tool to use. I think it's, we managed our businesses using that even when we were flush with cash. I basically use that tool all the time to present to management kind of where we were, where we're going. So I think it's a very useful tool. One thing I would say, though, as a business owner, it's fine to plug in the data, but make sure you're active, you're being proactive about actually managing the cash flow, meaning like if you know you're going to run out of cash over the next 2 weeks, or you're close to running out of the cash the next 2 weeks, then have your, if it's you or your controller or whoever, your acting CFO, have that person reach out to your customers to see, number one, if they can pay sooner, or provide some sort of incentive for them to pay sooner. Reach out to those key vendors and let them know. Sometimes you need to let them know what the situation is and whether you can extend those terms. So just don't kind of sit idly by and look at the data and realize, hey, I'm going to run out of cash in 2 weeks. what am I going to do? It's actually about being proactive, and making sure that you forcibly go out there and try to extend those terms. And the biggest thing about this thing is making sure that your salespeople too, that you're in tune with what they're doing, because ultimately all this flows from sales. So if you have no sales coming in, doesn't matter how well you manage your cash flow, there won't be any cash to manage. So that's the most important part of this whole process, is making sure that you have salespeople that are actually, or business development people out there that are actually out there selling your service. One other thing I would say too on the front end, as far as negotiating working capital, part of what's in the LOI that we talk about is when that LOI is written, there's a clause in there that says, that there's some sort of normal level of working capital that will be maintained in the business. The reason that's in there is to protect you from buying a business without any working capital. So a lot of times, you'll hear people, brokers will come up to the table and they'll sell a business, be like, yeah, but there's no working capital included. And you guys who've been around me for a long time know that that's not something that I'm going to accept from that standpoint. So the price that you're negotiating should include a level of working capital, because you're playing a multiple of earnings that included some level of working capital. Now, figuring out what that number is from a practical standpoint, if you get pinned down by a broker or seller who's actually wanting you to kind of define what that number looks like, we can tell them what the definition is, but sometimes they'll ask you, what is that number? You're going to have limited information up in the front of the process, at the beginning of the process. So what I would say is, if you need a quick down and dirty way of calculating what that number is and then negotiating from there, just take 3 months worth of expenses for a year. Of total expenses, and basically say, this is the working capital I'm going to need. If you have no understanding of how the cash flows, I think Dick talked about this earlier, you have to, or Dana, you have to understand kind of what the cash flow model looks like. But if you don't have that at the beginning, then you use 3 months of expenses as your proxy. If you have an understanding, you kind of know where they are on their receivables, if they're coming in every 30 days, then you're probably gonna have to cover at least 1 month's worth of expenses, but then add that bonus, that margin of safety that was mentioned earlier. Maybe ask for 2 months worth of expenses. If your materials are being covered by an upfront deposit, then that part of the expenses you don't have to worry about, because that's financing your materials generally. If you have jobs, let's just say materials and labor, if you collect for that upfront, then that part of it is covered, but you still have overhead and you still have those operating expenses you have to cover. So now you're in a situation where you're adding up 3 months worth of those expenses. But there's quick and down and dirty ways to come up with it if you're getting pinned down in the beginning of the process, and you can throw those numbers out there and use those as worst case scenario to negotiate from. But ultimately at the end, that number is going to be determined through the due diligence process. And then as we kind of get through that, you can kind of hone in and make sure that the seller knows, hey, I'm only going to ask for the working capital I need. Any excess maybe going to you. But we'll negotiate what that number looks like, because obviously you're going to get some from the lender, but you don't need to necessarily disclose that to the seller. But you want to make sure that you have enough working capital, at least at normal level, sort of a margin there. Now, one other thing I wanted to mention before we get out of here too, which is kind of leads back to kind of what I think Dana talked about it earlier. But when you get to a situation where you're buying a business that has a heavy construction component, you need to make sure, and I'll tell you that this caught an AE one time, and it's recent deal. But when you're going through and negotiating what the working capital is, part of the working capital definition does include your work in process. In jobs that you're currently working on, but you really have to hone in on that list at the end, because what's going to happen is let's just say you negotiate $500,000 in working capital and your WIP makes up $250,000 of it. That's fine and dandy, but what's going to end up happening at the end is the seller, knowing that they can accelerate some of those billings, may decide to take the low-hanging fruit, accelerate that, consider that excess working capital, and then walk away with the receivables. And they should be paying any direct costs related to those receivables with that. that's fine. But if you're left with then a bunch of jobs on that list where, you know, they're in play, but there's some hold up in the developer or whoever, if it, you know, if you're
Battery.
PC or
Power
developer,
off.
if they're indicating that, you know, if you find out that the job's on hold for the next 60 days, well, now you're in a situation where you can't bill for 60 days. And then once you bill for 60 days, you're probably not going to collect for another 60 days. So now you're in a 120-day hold. So the bottom line is, once you kind of hone in on what that final working process list is, then it's incumbent upon you to kind of go through job by job with the seller to understand exactly when am I going to be able to bill for this job, okay, and how long does it typically take for me to collect on that job. And then once they sign off on that, you should get that memorialized within your purchase agreement. Because what's going to end up happening is if something comes back and it's not true, you'll have some legal redress against the seller or some way to claw that amount back. And you'll be able to kind of have a lot more comfort from that standpoint. And one last thing I would say is, if you're looking at a work in process list and they're telling you you can't bill for 60 days, I would not even count that. I would have a formula set up to not even count that as part of your working capital. So if it's not something you can bill within like 30 to 45 days once you buy the business, I think you should kind of carve that out and separate that from kind of what your working capital calculation is, because that's kind of longer term and it's not going to help you in the short term. But that's really all I had to say.
Great advice.
Well, we've packed a lot in here, folks, and I, apologize for consuming the whole hour. We've got a few minutes left. Anybody have questions or your own comments you'd like to share with the group?
Doug, I will say I'll send you that 13-week rolling cash flow if you want to send it out to everybody, just so that they can look at it. Might be.
I'll be happy to. Yeah, we'll do that.
Hey, Rich, I got a question. Your
Low
favorite
battery. Power off.
favorite question person here.
Oh, James, I recognize your voice.
So this deal, I was the one I mentioned to you in on Slack. So the net working capital, at least on paper, is $2 million, right? Doing about $1.2 million in EBITDA. So very high net working capital. He's already kind of generally just, I don't know if I expect it, like I haven't gotten, far enough to figure that out. But then aside from that, I noticed that he has like a federal contract, right? So he has a GSA contract, like he's a supplier contract or something.
Mm-hmm.
And this has not been disclosed anywhere else, right? But on the contract, he has what is it? MBE or disadvantaged business designation,
Okay.
right? So he's I don't know, I guess he has some Spanish descent, maybe, right, from as far as I could tell. So then but that's not been disclosed anywhere. He has a large county contract that's like $30 million, right, that they got awarded last year that he said took them like 2 years to get.
Yep.
He didn't say anything about a minority designation. And then I looked up with the county, he's not listed as a minority business, right? Or a disadvantaged it's something else. Small disadvantage, I don't know, SDE maybe, small disadvantaged enterprise or something like that.
Yeah.
But it's not, he has nothing on file with the state, right, where the majority of this revenue is coming from. It's not coming from the contract. What do you think of that? As far as like, is it just a thing? Maybe he just had it for the government thing. Is that something I should be worried about? Like if he doesn't have the designation on file, like with the state, for example, is that something that could come back?
Yes.
Okay.
You
All right.
want to be worried about that, because if you don't,
Okay.
if you're not fitting that profile, that
Right.
contract can be easily lost. The business could lose that business. There's creative ways around it. If you bring someone on as a partner that that has that status, but they would have to own the majority of the business. So in essence, you're defeating the whole purpose of acquiring the business. But yeah, I mean, that's something you know, you want to be very careful with that if you're not part of that group, because all of a sudden you get into a situation where you're buying that business, and if that work is continuing and the new owner isn't, you get in a situation where the government does, obviously they're going to do what they can to make sure. They're going to audit at some point. They're going to audit to find out who you are, and they're going to know who you are. But at some point, the government can claw all that money's back, and then hit the company with some sort of a penalty or what have you. So you want to just be very careful with that. And if you're in a situation like that and you're not sure, you definitely want to speak with an attorney that has that specific expertise around you know, disadvantaged minority designations with businesses and that sort of thing. But yeah, I mean, that one situation, you should be worried about it.
Okay. So even if it's not listed like with the state, that was the thing. Only reason I found it was because I specifically looked up their government contract, which had it.
Yeah.
And then it didn't anywhere else, essentially. And they never brought it up. Not in the Senate,
Generally
not
a
anywhere.
federal designation, but at the same time, if you're doing state work and the state work is based on that federal designation, then you
Got it.
definitely.
Okay, so they could be looking at that and be like, okay, gotcha. Okay,
Yeah.
okay.
Play.
That makes sense.
And especially if you're looping the SBA into this, now you've got a little bit of a double jeopardy for potential misrepresentation of your status if
Sure.
you don't get it secured properly up front.
Got it. Okay. That makes sense. So that's definitely a red flag. I was like, oh, maybe it's not. Maybe I'm overthinking it. But no, when I initially saw it, I was like, oh, perfect. Of course. Right.
Yeah.
Everything looks good. And the thing I find, right, not declared anywhere, right?
Gloria, you had something you want to add?
Yeah, James needs me as a partner.
Ah,
I'm Latina woman, so
she's got extra boxes.
Extra
Hey,
boxes to check.
I
Yeah,
can actually. Hey, are you looking in Tampa? Because maybe we can connect, or I can show you if that is the case. Maybe, you know, it's a 36-year. It's a strong business.
okay.
If you're looking, if it is this case, I'm happy to connect you and get you the information.
Right.
Okay, so we need to connect.
Yeah, well, I'll connect with you on Slack.
Okay, good.
All right. Stephen, you've got a question, sir?
Yeah, hey. I'm doing a seller call on Tuesday, and just based on some of the information the broker has shared, like I already know that they want the buyer to pay for inventory. They want the buyer to, they don't want to give cash or cash equivalents. So I'm assuming they don't want to give working capital. Is it worth figuring that out and resolving that with the seller or the broker? Is it something to discuss on a seller call, or is it something you kind of like wait for until later, like after you submit an LOI or an offer? Like where do you suggest like handling that, or like if I'm interested in the business?
Like what are they telling you they're not going to do?
I guess like they shared some financials, and it says in the financials like, oh, like inventory is not included, and like cash and cash equivalents are not included. So it sounds like they probably want you to pay for that separately from their asking price, which is already kind of above the multiples, like a bit above the multiples that Acquira suggests. So
Well, that's a case where we would
figure out
calculate
kind of
the value
later.
of the business without the working capital and offer them that price, because you're going to need the working capital at some level. If you can't get it from the seller, then you're going to have to get it from the lender, but you can't overpay for the business and expect to get it from a lender. So we would just make an adjustment for that and tell them, look, this is the price. My approach usually is here's the price with working capital as defined, you know, and lay out kind of what working capital means to you. But here's my price with working capital. Here's the price without working capital. Which one do you want? Because
and inventory, right?
Yeah. Well, inventory is part of the working capital. So especially it's more important. Inventory is more important if it's sellable inventory versus like buying. Let's just say you buy you buy a cabinet manufacturer and their inventory is like, you know, the business is doing, you know, $2 million a year in revenue, and their inventory is like $15,000, and it's like screws or something like that. Okay, that inventory isn't as important as if you're buying a retailer where basically their revenue production is from the inventory. So they're basically purchasing inventory and they're selling it, or they're manufacturing inventory and they're selling it. So in that case, I think the inventory question is a little bit different, but if it's something where
How about for HVAC?
Oh, it depends on what kind of HVAC company it is. Is it parts that go into an HVAC system, or is it selling HVAC systems?
Yeah, selling HVAC, like 70% new construction and the rest replacement, repair, maintenance.
Is the inventory like actual HVAC systems, or is it just like parts?
I'm not sure yet.
Yeah, that's important. I mean, the parts could still be the parts are still, could still be an important component of that. But like, say if you're an HVAC company and you're an HVAC installer, but you're also a reseller. Well, in that case, the HVAC systems are part of your revenue base. So that's a huge consideration if they're not going to include that, because now you have to go out and buy or contract with with Train or whoever and get new HVAC systems.
Yeah.
So it's going to cost you some extra money from that standpoint.
Yeah. All right, folks, unfortunately, we're kind of up on time. Thanks, everybody, for sitting in. I hope this was helpful. We will get the audio and video recording of this up online early next week. So if you need to go back, there's a lot of data here that we shared. So feel free to go back over. And as always, reach out to us on the Slack if you've got a question. And with that, I'm going to say goodbye. I hope everybody has a great weekend.